So if you are listening to this right now, chances are you've looked at a market chart at some point and thought you spotted a pattern, like a trend or a rhythm.
Yeah, humans love patterns.
We really do. We are totally wired to look for order in the noise. But, what happens when the noise becomes so violent, so structurally chaotic, that every single pattern you've ever relied on just completely shatters?
Well, you're basically left in a survival situation. And you're forced to figure out if your underlying philosophy for navigating risk actually works when the normal rules of physics, no longer apply.
Which brings us to today. Welcome to today's deep dive. We are unpacking a genuinely fascinating piece of raw data. It's a highly detailed observation log titled endnotebook.txt, and this comes to us directly from Team AI Lab, dated May 25th, 2026.
It's a really incredible document.
It is, and our mission for this deep dive is to basically tear down the simulation of algorithmic survival during a highly chaotic market environment. We are looking at two radically different strategic philosophies, like two completely different ways of life for these data models as they attempt to adapt when all the traditional market barometers break.
Right, but before we go one step further, we really have to establish the boundary of what this conversation actually is.
Yes, absolutely.
This is critical for you listening. We are looking at an observation log of proprietary algorithm behavior. It is under highly specific experimental simulation conditions.
Pure observation. Let me be unequivocally clear here. We are not giving investment advice today.
Well, not at all.
There are absolutely no buy or sell recommendations in this analysis.
Yeah.
And no one is promising, hinting at, or suggesting future profits. Like, if you are looking for stock picks, you are definitely in the wrong place. We are taking a cold, entirely objective look at how mathematical models react to extreme stress.
Exactly. We are essentially researchers examining lab results. The stakes in this simulation are high from an evolutionary data perspective, but to you, the listener, this is purely about understanding the mechanics of adaptation.
Right. So with that stance locked in, let's look at the board. Team AI Lab has split their algorithms into two opposing camps, and they're facing this massive systemic storm in the market. On one side, we have Team Mountain Climbers, and their operating philosophy is equilibrium detection.
Yeah, and let's break down the mechanics of what equilibrium detection actually means, because it's not just a poetic name.
It's very literal.
It is. These algorithms are utilizing strategies like statistical arbitrage and mean reversion. They basically operate on the assumption that while the market might swing wildly, certain relationships between assets will always snap back to a historical average.
Okay.
So they are scanning the chaos to find the unmoving place, the exact coordinates where the mathematical ground isn't shaking, so they can plant their flag and lock in a highly probable, albeit really small, return.
Got it. And on the completely opposite end of the spectrum, we have Team Wave Riders. Their philosophy is surging force tracking. They have zero interest in equilibrium.
Oh, a calm market is actually a hostile environment for a wave rider.
Because they need movement.
Right, these are momentum algorithms. They're looking for volatility breakouts. Their underlying math tracks the velocity and acceleration of order flow. They want a high beta environment, and they are designed to identify and ally themselves with violent directional momentum.
They want the chaos.
Exactly. They don't want to find the unmoving place. They want to attach themselves to the most aggressive moving object they can find.
So for you listening, I want you to picture yourself caught in a Category 5 hurricane. You basically have two choices for survival. You can either find the heaviest, most deeply embedded rock and anchor yourself to it and just wait for the wind to die down. That's the mountain climber.
Right.
Or you can grab a surfboard, paddle out into the storm surge, and try to ride the tidal wave. And that's the wave rider.
Which is a really compelling image.
Yeah.
But we need to ground it in the data from May 2026. Because this simulation isn't just a rough day of trading, it is a structural tempest. The correlations that normally govern these markets have completely detached.
Which actually brings us to the season standings index contrast in the log. And I have to admit, when I first read these numbers, I genuinely thought there was a typo in the data set.
It looks wrong at first glance, yeah.
It really does. Both teams are showing a massive, nearly identical negative gap against traditional benchmarks. So the mountain climbers are sitting at negative 7.4 points compared to the Nikkei 225 and negative 3.7 points versus the TOPIX.
Wow.
And then the wave riders are at negative 7.8 points against the Nikkei and negative 4.0 points against the TOPIX.
They are essentially mirror images of underperformance against the established indices.
Yeah, and I have to push back hard on what Team AI Lab is doing here because, if If you or I were running a portfolio or managing a team of quants, and our algorithms were universally lagging the Nikkei by nearly 8 full points, we wouldn't call that a fascinating observation. We would call that a catastrophic failure.
You pull the plug.
Exactly. Why are we even looking at this data if both of these radically different mathematical approaches are seemingly broken at the exact same time?
Well, because you're assuming the index is still telling the truth.
What do you mean?
You're assuming the Nikkei and the Topix are accurately reflecting the reality of the market environment that these algorithms are actually operating in.
Are they not? I mean, an index is the definition of the market average.
Under normal conditions, yes, absolutely. But in the kind of extreme regime change we are seeing in this simulation, the index becomes a ghost. Yeah, it becomes a lagging indicator. It gets propped up by structural mechanics that have absolutely nothing to do with the actual granular trading environment. Like, for example, in highly distressed markets, an index like the Nikkei might be artificially buoyed by a handful of mega-cap stocks.
Oh, or central bank interventions?
Exactly. Central bank interventions are a classic example. Meanwhile, the underlying breadth of the market, the actual ecosystem where these mountain climber and wave rider units are fighting for yield, is completely collapsing.
Okay, so it's like the weather station says it's sunny because the sensor is broken, while the actual units on the ground are just getting hammered by hail.
That is exactly it. So the divergence of -7 to 8 points across both strategies, it doesn't prove the algorithms are broken. It mathematically proves the environment has fractured, that the normal rules are just gone.
Wow.
So the true story isn't in how these units compare to the Nikkei anymore. It is strictly in how they survive against the raw elements of the market itself.
That is wild. Let's look at how Team AI Lab actually manages that survival. Because they don't just, dump the algorithms into the market and walk away. There is a highly regimented deployment system. Every single day at 9:00 a.m. Japan Standard Time, they run a daily scouting process to draft what they call new talent.
And the constraints on this new talent are brutal.
Oh, yeah.
Once drafted, a unit is given a strict 10-session mandate. They have 10 market days to prove their underlying logic generates a positive expectancy. If they don't, they are terminated. It is forced evolutionary pressure.
And look at the disparity in the scouting data for today, May 25th. The mountain climbers drafted 4 brand new units into this meat grinder.
4, right.
But the wave riders, they managed to scout a grand total of 1. Just 1. Why the massive gap there?
You have to think about the mechanics of what they are looking for. A wave rider requires a surging force. It needs a statistically significant momentum breakout. But in a market where the rules have broken down, volatility usually turns into pure directionless static.
Just noise.
Total noise. It's whipsawing, it's chop.
Meaning, like, a stock might spike 3% in 5 minutes, which would trigger a momentum signal, but then immediately crashed 4% in the next 5 minutes.
Exactly. The algorithm is constantly getting faked out by false breakouts. So when the daily scouting protocol scans the market for clean directional momentum to justify drafting a new wave rider, the math simply isn't there. The conditions are too erratic to generate a reliable signal. Honestly, finding one candidate is actually surprising.
Wow. Meanwhile, the mountain climbers found 4.
Because equilibrium detection doesn't need a clean trend. It looks for micro inefficiencies. Even in the absolute worst, most chaotic market chop, 2 highly correlated assets will briefly deviate from their historical spread.
Right.
A mountain climber algorithm spots that tiny fracture, steps into the void, captures the mean reversion, steps out. So detecting micro pockets of stillness is simply yielding more algorithmic candidates right now than searching for a massive clean wave.
And that plays out dramatically when we look at the main forces. The active roster of units that are currently deployed and fighting through their 10-session mandates. The mountain climbers have 7 active units deployed right now. The wave riders have 8. And the survival rates are telling 2 completely different stories.
This is where we see which philosophy is actually keeping the lights on in the middle of the storm.
Yeah. For the mountain climbers, 6 out of their 7 active units are currently holding positive points, but for the wave riders, only 4 out of their 8 active units are in the green.
The wave riders are taking a 50% casualty rate on their active roster.
Half of them are underwater. Like, if you are a momentum trader looking at this data, this should give you serious pause. Attempting to ride the surging force in a structurally broken environment is just getting these algorithms torn apart.
It's brutal.
Yet, almost the entire active team of mountain climbers, 6 out of 7, are acting like miraculous lighthouses in the dark. They are holding their ground.
The data is providing a definitive answer regarding short-term survivability here. Seeking stillness works better than chasing chaos when the market structure itself is dissolving. The mountain climbers aren't holding long-term directional risk.
They're just getting in and out.
Right. They are minimizing their exposure time, taking small, highly probable profits, and getting back to neutral. They are surviving by refusing to play the market's chaotic game.
But, the deeper we go into the log, the more the narrative twists. I want to look at the exit data and the final standings, because what seems like a clear victory for the mountain climbers on the surface, it actually hides a massive mathematical paradox.
Oh, you're talking about the aggregate scorecard.
Yes. We know the Wave Riders are bleeding, half their active roster is negative, and today, they officially lost a unit. A Wave Rider algorithm that was operating specifically in the machinery sector hit the end of its 10-session mandate, and it was forced to exit with a score of negative 5.3 points.
A localized wipeout. The momentum signal in the machinery sector clearly failed, likely due to that violent whipsawing we discussed earlier.
Right. It's a heavy hit. And when you factor in their carryover balance from previous sessions, the Wave Riders are sitting in a massive hole. They started the day with a carryover of negative 29.1 points. They are objectively taking a beating.
It's the cost of doing business when your philosophy relies on capturing rare, explosive moves.
But look at the daily score they pulled off today. Despite a 50% casualty rate, despite the negative 5.3 point wipeout in machinery, the Wave Riders generated a massive daily score of positive 88.0 points.
88 points in a single session. That is incredible.
It is an absurd number. That explosive daily score single-handedly dragged their total season points out of the negative void and up to a positive 55.2.
And how does that compare to the steady, surviving mountain climbers?
Well, this is the paradox. The mountain climbers are keeping almost everyone alive. They have a healthy, positive carryover balance of 14.3 points. Today, they pulled in a very respectable, moderate daily score of positive 23.2 points.
Very steady.
They are the definition of consistent. But when you tally up their total season points, positive 54.4.
So they're actually trailing the Wave Riders in total points.
How does that make sense? I mean, the Wave Riders are suffering a 50% failure rate. They're taking defined losses like the negative 5.3 in machinery, but their daily score explodes by 88 points. It's as if, it's like 9 surfers paddled out, wiped out completely, broke their boards, and got dragged under. But the 10th surfer caught a tsunami that was so massive it carried the entire team's aggregate score to victory.
Right.
Meanwhile, the mountain climbers are inching their way up the cliff face, never falling, never taking a hit, but they end up with slightly fewer total points.
What you were describing is the fundamental nature of asymmetric risk and return. It's a power law distribution.
Break that down for me. Why does the math favor the reckless strategy here?
Well, it doesn't necessarily favor it. It's just a completely different distribution of outcomes. The Wave Riders' philosophy is inherently designed to absorb a high frequency of small to medium failures. That negative 5.3 point exit isn't an accident.
Oh, it's intentional.
Yes, it's the algorithm hitting its stop loss.
Yeah.
It cuts the failure quickly. But when one of those units actually manages to track a true, sustained, surging force in the middle of all that static, the upside is uncapped. That 88-point gain represents the fat tail of the statistical distribution. One perfect ride mathematically erases the losses of all the wipeouts.
Okay, so they lose small often, but win massively when they are right.
Correct. Now, the mountain climbers, they operate on a normal distribution. They represent quiet consistency. By anchoring themselves to equilibrium, they guarantee a high win rate like we saw, 6 out of 7 units surviving. But the trade-off for that safety is that their upside is strictly capped. You can't capture an 88-point momentum wave if your core programming forces you to revert to the mean. They survive the storm beautifully, but they are structurally incapable of harnessing its energy.
Which forces us to look at this entirely through the lens of Team AI Lab's research stance, because human psychology completely breaks down when trying to execute a Wave Rider strategy.
Oh, absolutely. If a human trader watches half their portfolio bleed out and takes a hard negative 5.3 point loss in the machinery sector, panic sets in.
Naturally.
Yeah, the emotional toll of constant small failures usually causes a human to abandon the strategy right before the 88-point wave arrives.
But Team AI Lab isn't feeling pain. They are looking at an observation log.
Exactly. To the researchers, that negative 5.3 point exit isn't a defeat. It is vital, cold, forward-looking data. Every time a Wave Rider wipes out, the algorithm maps the exact coordinates of the failure. It maps the contours of the market static.
That makes a lot of sense.
Yeah, that localized failure is mathematically necessary to build the next iteration of the strategy. It is the cost of discovering the tsunami.
You know, if you are listening to this, you might be wondering why the internal logs of a proprietary AI lab from May 2026 matter to you. Because let's face it, you probably aren't programming statistical arbitrage algorithms on the weekends.
Probably not. But the underlying principles of adaptation apply everywhere.
They dictate everything. This log is a masterclass in how to navigate environments where the rules you rely on suddenly change. I mean, whether you are managing a business, leading a team through a volatile industry shift, or simply trying to navigate personal chaos, you are constantly confronted with this exact philosophical choice.
When your traditional barometers break, what is your default mechanism for survival?
Exactly. When the storm hits, do you default to being a mountain climber? Do you seek equilibrium? Do you anchor yourself, find that micro pocket of stillness, and focus entirely on preservation, consistency, and surviving the night?
Or do you have the risk tolerance to be a wave rider? Do you accept that you are going to take repeated, painful hits, that you will experience a 50% failure rate in the relentless pursuit of finding that one chaotic, surging force that you can ride to massive asymmetric growth?
And the data from Team AI Lab proves there is no single right answer here. Both strategies reached the end of the simulation with roughly 55 total season points. They both survived the storm, but the paths they took to get there couldn't be more different.
Day and night.
Right. One path was a slow, steady, quiet climb in the dark, prioritizing safety over magnitude. The other was paved with high casualties, defined failures, and explosive, mathematically violent upside.
The key is understanding the structural reality of the storm you are currently in and brutally assessing which philosophy your system, your capital, or your mindset is actually built to endure.
That is the core takeaway. But spending time with this data leaves me with one final, deeply provocative thought. We spent this entire deep dive looking at the mountain climbers and the wave riders as pure, isolated, rigidly defined philosophies.
They are constrained by their core programming.
Right. But what happens if the market environment becomes so permanently erratic that neither pure strategy is optimal? What if the next evolution of Team AI Labs models involves an algorithm that learns to state switch mid-storm?
Oh, wow. A dynamic hybrid model.
Think about the implications of that. Imagine an entity that can anchor itself to the cliff face like a mountain climber during the absolute worst of the market static. It patiently executes equilibrium detection, takes absolutely no directional risks, and simply survives while everyone else bleeds out.
Okay, I see where you're going with this.
Right. But then, the very millisecond its sensors detect a statistically valid momentum shift, a true structural change in the order flow.
Yeah.
It mathematically detaches from the rock. It overrides its mean reversion programming, adopts the surging force tracking of a wave rider, and surfs the chaos for explosive upside.
Evolving from stone to water and back again in real time. That is, it would require an entirely new meta layer of logic just to decide which philosophy to deploy at any given second.
It would be the ultimate adaptation. Because if you can find the discipline to remain perfectly still in the hurricane, you just might be the only one with enough capital left to ride the perfect wave when it finally arrives. It's definitely something to think about the next time you find yourself caught in the chop.